Alright, let's begin by taking a look at how markets performed this past week. US equities closed the week on a high note, with the Dow Jones Industrial Average hitting a record. This marked the Dow's third consecutive week of gains. The S&P 500 dipped slightly on Friday, while the NASDAQ composite followed due to a 2% decline in Nvidia. Encouraging inflation data rise and the personal consumption expenditures index bolstered investor sentiment regarding potential interest rate cuts from the Federal Reserve. Asian markets experienced significant rallies led by Chinese stocks, which posted their best week since 2008. The CSI 300 surged 15.7%, driven by economic stimulus measures from the People's Bank of China, included a rate cut. Hong Kong's Hang Seng Index gained 12.75%, marking its strongest performance since 1998. Oil prices fell this week, with US oil dropping about 5% despite escalating geopolitical tensions in West Asia. Soft demand from China continued to weigh on prices, leading to speculation about OPEC, plus the possible delaying planned output increases. Gold prices edged down on Friday after reaching all-time highs. The metal, traditionally seen as a haven, has gained approximately 29% this year. Looking ahead, next week investors will focus on upcoming economic data releases, including the Fed's senior loan officer survey and further insights into consumer sentiment, as well as potential developments surrounding US monetary policy and global economic conditions. Now, for more on this, we're being joined by Mitali Noor. Is she an economist, joining us from New Delhi now? Thank you so much this morning. Now let me begin by asking you, will US payrolls data support another jumbo-sized race cut? So
I think that's the core question around all of the speculation that's now going on around the November meetings. So let's recall actually what's been happening, right? So we've been seeing that the overall inflation rate in the US, the target is around 2% for the Federal Reserve. That's their internal target that they set for macroeconomic stability and for price stability in the US economy, that was at around 2.3%, and a lot of economists, including myself, were expecting the September meetings to throw up a rate cut of about 2.5%, but the Fed went ahead and did a rate cut of 5%, backed by two major statistics. The first was around personal consumption expenditure. Personal consumption expenditure data came in at 1.8% increase in August 2024, with a projection to keep on falling. So the Fed's basket of goods and commodities, goods and services that people use on a daily basis, showed only an increase of 1.8%, which helped them justify the rate cut. Now, with the jobs data, there's another motivation for another rate cut in November, because the jobs data came in at 4.2%. Unemployment in August 2024 projected to rise to 4.4% by the end of 2024. So therefore, a lot of economists are now calling for the Fed to say, what you've done one deep rate cut, do another one, because at this point in time unemployment is a bigger problem than inflation.
Right, so that being said, you mean to say market expectations for another large Fed rate cut is justified?
So at this point in time, I would say that we should look at the trends and the way the winds are blowing. So if we look at the descending note, for example, that Michelle Bowman has released, she in fact advocated for a more muted 25% rate cut even in September, and continues to call on the fact that house prices are rising. It's not only about just goods and services, but housing and mortgage and rent. These make up a very large percentage of the consumption basket for a normal consumer, and the inflation in house prices is much higher than personal consumption expenditure. So I think at this point in time I would not personally be expecting an outsized rate cut. I would say if they've gone for the deep rate cut in September, maybe they will go for a more muted rate cut in November. But also I would say that it depends a little bit on the election result, because affordable housing is a plank on which Kamala Harris is contesting, and if she would like the government to support more of her affordable housing agenda, it might be a more muted rate cut that we see.
Right, so will the Fed be able to boost the economy and limit a hit to the labor market?
So I do think that the first rate cut that's been made just now, in September we've seen that 5% cut come in, and they're going to now get data over the next 2 months to see if this projected increase in unemployment rates which I just mentioned, will go to 4.4 can be stemmed and can be reversed in the next 2 months. If it cannot, then definitely another deep rate cut is on the cards, and it is really at this point in time up to the Fed through monetary policy to stimulate the economy. At this point in time, the Fed is not expecting the fiscal policy to be able to be supportive because of the change in government, and I think fiscal policies to support the economy will only start taking impact in March, 2025 by, say Q1 2025. So, in the next 6 months, Fed rate cuts can be expected. How deep they will be will depend on the September-October jobs data and the impact on housing prices.
Right, and you mentioned the November elections as well, so the Fed is being criticized for its big cut so close to an election. What is your take on this?
I don't think that's quite fair to criticize the Fed at this point in time for a deep rate cuts close to the election. They are not basing their decisions, and they've said this 100 times, that they're not basing the decisions of rate cuts or rate increases on the election cycle, but rather on the health of the economy. And at this point in time, if the fiscal side and if the governance side is engaged in the elections, then at least the monetary policy and the monetary authority is providing the stewardship on the economy. So, and I think this is also quite different that you see from many emerging economies or even other developed economies, where Federal Reserves typically wait for directives in the one sense, or at least cues from from the government elected. But I think it shows the independence of the Fed, and I think we should know that. Thanks for watching this video.